All right, welcome back to the Know Your Numbers REI podcast. Your host, Chris McCormack, CPA, certified tax planner, honored and grateful to have you listening. We love to hear from you guys. So if there are any topics that you think would be of value, please reach out to me, Instagram, Facebook. You can even comment on the Spotify or YouTube, and we'd love to hear from you. We do take into consideration the comments that we hear and the things that people want. And if you haven't already, join our Facebook group, Tax and Accounting for Real Estate Investors. You can reach out to us there and talk about topics that you'd want to hear, or just ask tax related questions there. There's about 1,000 members right now, and we'd love to have you join us there. Today, we're going to be jumping into a topic that is of interest to many, and that is the short-term rental industry. Short-term rentals have taken off in recent years. I think it's probably slowed a little bit because of certain regulations that have come, and certain local industries or local governments are looking to cut down on the amount of investments in short-term rentals or the amount of short-term rentals that are available. But that's not to say that the short-term rental market isn't still booming. We had a recent guest on, John Bianchi. He is doing a lot of great things in the short-term rental market. And so if you haven't listened to that episode yet, go ahead and do yourself a favor and listen. Great stuff. And if you are a high income earner or somebody looking to kind of take a seamless approach to the short-term rental space, John might be a great partner to have, and you can listen to that episode and hear more about what he has to offer. But that all in mind, short-term rentals do offer some great tax saving opportunity, and we're going to be diving into that today. So how can you make use of short-term rentals? How can you use short-term rentals to save on tax? Did you know that short-term rental owners can even avoid certain taxes? There's a self-employment tax that is often dreaded in many industries, but even in the short-term rental space. But many investors don't understand that they can avoid this dreaded self-employment tax by just applying certain things that the tax code has put in place for us. If you own an Airbnb or VRBO, you might be sitting on some hidden tax savings. Today, we're going to be diving into the unique tax benefit that is available to short-term rental investors, the key deductions that hosts should know about, and how to legally minimize your tax bill. We are all about legalities here. We want to make sure that we are saving on tax, but we're doing it in a way that is put forth by the IRS, verified by the IRS, not just the IRS, but the court cases that have gone through to benefit us in some way. So let's get into it. We know that many short-term rental hosts don't understand tax rules and either underpay or overpay as a result. So neither of those things are a good thing, right? If you're overpaying, you're losing money. If you're underpaying, you're opening yourself up to lost audits, interest, penalties. You're also breaking the law. Again, we want to make sure everything we're doing is according to the law. You guys miss key deductions like furniture depreciation, supplies, utility, even some that might seem a little more obvious, like the mortgage interest or the repairs and the maintenance and the renovations that you put into it. Maybe it's something that you're adding to add value to your property and you don't deduct the whole thing or don't deduct it in the most optimized way. You are missing out on savings. You're unsure about how to properly report income and avoid IRS red flags. Do you need to include all of the income, or do you include the net after Airbnb or VRBO has taken their fees? What form do you report it on? Is it on Schedule C? Is it on Schedule E? Is it Form 1065 for partnerships? Is it an S corporation? How do you structure this properly? We have all the answers. Let's consider a real life client. Let's call his name John. He bought a vacation rental in the sunny state of Florida. He has other investments, but this was his first short-term rental on Airbnb and VRBO. He was worried about the tax implications as it had a greater profit margin than his other investments, and he wasn't sure how it would affect him. He also had a W-2 where he was making money and paying taxes regularly, but he did not want to face a big tax bill as a result of this short-term rental. He got into investments because he heard of the real estate benefits, but then he also realized he had no idea how to maximize those real estate tax benefits, how to capitalize on those real estate tax benefits. And so he hired us, and within 1 month of working with us, we saved him over $50,000 in tax. I had him kind of give us a review, and he told us that it was his largest refund to date, and because of it, he's been sharing the power of real estate with others. And again, this is all with the W-2, so let's just call it blasphemy to those who say that you can't save money on taxes when you have a W-2 income. It's one of the most upsetting things when I hear people say, because you have a W-2, there's no way that you can save on tax. It's a lie. And so we have our client here, who we're calling John, saved $50,000 in taxes with a W-2 while investing in real estate, and it's possible for you to do the same. But without understanding the tax benefits, you, the short-term rental investor, the host of an Airbnb, are leaving thousands and if not tens of thousands of dollars on the table. So let's go through 4 strategies that we can use. One is a tax-free rental loophole. You can rent your property out for 14 days or less and not have to report any income. People refer to this as the Augusta rule. It's because of Augusta, Georgia, the Masters tournament. You have a lot of people going to Augusta for less than 14 days. You have people going to Augusta for 4 days. You have people going to Augusta for 7 days. Augusta is a great place to live outside of that. However, the people that live in Augusta and might not want to go to the Masters tournament might leave and rent out their property. Thousands of people are doing this and reporting the income even though they don't need to. And it's not just in Augusta. I've seen this with vacation homes. I've seen this with beach houses. I've seen this with all sorts of things. You rent the property out to make a few extra bucks. In Augusta, you rent it out and you can charge a crazy amount to people who are going there. I'm going to Boston, the Boston Marathon. During the Boston Marathon, the rates on hotels and rental properties skyrockets. It increases. It's probably 2-fold, maybe even 3-fold than other times that you want to go to Boston because there's 30,000 people running a marathon. It is one of the most famous marathons in all of marathons throughout the world. And so they're going to charge you a larger amount than they would, say, if you went to Boston in the middle of July. Okay, so if you have a property in Boston and maybe you're not going to be in town or you've been to the Boston Marathon, you have no interest and you want to make a few extra bucks, well, you can rent out your property for a larger rate than if you rented it out any time of year and collect that and not pay taxes on it because the tax code says if you rent it out for 14 days or less, you don't have to report the income. So that's one opportunity if you have short-term rentals or you want to get into the short-term rental space. However, if you go over that 14 days, so you're renting it out more regularly, you have to report the income. So what do you do then? Well, depreciation is a great opportunity. Depreciation is what we use in the tax space, the real estate tax space, to account for the wear and tear of properties, right? Typically, when you buy a property, it's pretty well known that if you buy a car, the value of that car goes down astronomically the second you drive it off the lot. That is because of depreciation. Things depreciate, they deteriorate over time. The great thing about real estate is that oftentimes you can get a depreciation benefit for money that you haven't paid, right? So if you use a mortgage and you're leveraging debt to get into the property, then you paid $50,000 for a $500,000 property, and you can depreciate the whole $500,000 minus land. Let's say $450,000 of it is depreciable. You get a deduction for that $450,000 even though you didn't pay for all of it. You're using debt. And also add to that the fact that appreciation, the increase of something over time, is likely happening to your property. So you get a benefit for something that isn't necessarily deteriorating. It's a beautiful thing. And when you're in the short-term rental space, you're also providing things like furniture, kitchenware, appliances. These things too can be depreciated, and oftentimes at higher levels than what the everyday tax accountant might depreciate, right? Your everyday tax accountant might depreciate it over 7 years when you can get the full thing in year 1. I just had a client who had this. They had about $50,000 worth of furniture in a short-term rental that was being depreciated over 7 years. They could actually depreciate it in year 1 for the full amount, and it's costing them a large amount in taxes. So we have the tax-free rental income loophole. We depreciate everything, offset income with expenses, things like mortgage interest, utilities, maintenance, platform fees, supplies, all of the things that you are paying for to be into your short-term rental so your guests have a positive experience, they can be deducted. Some of them will be depreciated, but most can be deducted. Make sure you're tracking it, track everything, and offset the income with the expenses. And number 4, this is a big one. Understand the self-employment tax rules, right? So self-employment taxes is one of the largest mistakes people make. They don't have the right entity structure, so they're paying 15.3% of their gross profit in self-employment taxes. In real estate, it is an even greater mistake because oftentimes tax accountants who don't know all of the ins and outs of short-term rentals and real estate investing think for some reason that you're supposed to report this income on Schedule C, and therefore any profit you make in your short-term rental is taxed at the self-employment tax level on top of just your regular federal income tax. That is a massive mistake. They are misled. They don't fully understand the real estate investing tax law. If you are not providing what they refer to as substantial services, which is like cleaning on a regular basis while your guests are still there, cooking, things like, think of a hotel, like if you're providing maid services and breakfast and all these things, well, then we might have to report it on a profit and loss that you would have on Schedule C or even on a business return. But if you're not providing that, which most people aren't, chances are you'll be on a rental income and avoid the self-employment tax altogether. And this is something that is missed so often. I see it probably at least once a year, multiple times a year, if we're taking on a lot of prospects. You can save tax by getting it on the right form. Again, this is all the right way of filing taxes and planning for taxes. This isn't some scheme to get you out of paying taxes. This is what is set forth in the tax law. I can point to the code and the wording that says if you're providing substantial services, it's a business. If you're not, it's a rental property. There are specific wordings that allow us to take that liberty, and putting it on Schedule E is in accordance with the tax law. Putting it on Schedule C actually isn't, and it's going to result in higher taxes. But the IRS isn't going to come telling you that you put this on Schedule C, it belongs on Schedule E. They're going to say, oh, you paid us $10,000 more than you needed to? Okay, we'll take it. No questions asked. So these 4 things are what you need to do as a short-term rental investor to save on tax, to make sure you're doing it in a legal, ethical way, in a way that is going to save you the most amount of money. This is not an exhaustive list. Our client, who I referred to as John earlier, took it one step further, and that's what resulted in the $50,000 refund. But if you're starting from scratch, this is a good place to start. The next thing would be to reach out to a tax advisor who's going to help you, who's going to guide you, who's going to make decisions for you and help you capitalize on the law that is available to you. Okay, so when it comes to short-term rentals, let's talk about an action step that we can take before the next episode is released. I would say start tracking your expenses and maximize your deductions. That's probably a good starting point. If you've gotten that, then maybe it's time to reach out to a tax advisor, a tax strategist, somebody who can help you plan and save on taxes. If you are a W-2 earner and you're investing in short-term rentals and you are not seeing these massive refunds, chances are you are overpaying and you're not using the full tax code as it's been set out for us. And if that's you, then reach out to us. Let's get some time on the calendar, find out how we can save on tax, and implement a plan and a strategy. I understand some of these things can be stressful. It seems overwhelming. It's tax time. You're not sure what you can apply. Take a small step. I'm telling you, small steps will start to compound and you will be at a place far further along than you ever dreamed of a year from now if you start taking small action steps now and get real about tax savings and creating a plan that can change your life. Until next time, God bless you and keep moving forward.